Hello everybody, this is Alan at Alan Talks FinTech. Today we're going to talk about dividend stocks, some of the basic principles behind it. So this would be good if you're just starting to learn about dividend paying stocks and want to invest in them. So as always, please click the subscribe button. That way you can get any videos that I produce later. Click on the like if you like the content. Provide your feedback. So a dividend is a payout from a company to its shareholders. It's paid on the profits. So the profits or the earnings for a particular quarter, the board of directors will get together. They'll announce the earnings. They'll announce the ex-dividend date and the pay date. Now the payment is usually in cash, but you can also use that money to reinvest into buying additional shares. The company will announce their dividends on the declaration date. Now, to actually get the dividend, you have to have held the stock or purchased the stock a day or earlier before the ex-dividend date. So the ex-dividend date is the date, if you purchase it on that date or later, it is without dividend or ex-dividend. There's also a record date, which is the date that follows the ex-dividend date in which your ownership is recorded by the company. That's how they'll know to pay you the dividend. And then the dividend is actually paid on the dividend pay date. That's the day you'll receive the dividend in your account. Now, the dividend rate is how much the dividend is per share. It could be $1 per share, it could be 10 cents per share. It really varies quite a bit. The yield is just that rate divided by the share price, expressed as a percentage. An important thing that dividend investors pay attention to is called the dividend payout ratio, which is of the earnings or the profits that was announced, how much of that is going to be paid as dividends to the shareholders. And we'll talk a little bit more about that later. Some companies, they offer dividend reinvestment plans, which allowed you to buy additional shares of the stock without having to pay a commission or a lower price. But these days, most brokerages have automatic dividend reinvestment into the underlying stock using fractional shares and with no commission. So you don't see DRIPs mentioned too much now because the brokerages kind of handle it for you. And we'll talk a little bit more about taxation of dividends, but it does vary, especially for a non-retirement account or a non-tax deferred account or taxable account. So it depends how long you've held the stock, and we'll talk about that in a slide coming up. All right, so suppose you want to look up a dividend. So on Fidelity's website, you can just do a search for the company's stock symbol. So in this example, I'm using Dominion Energy, which symbol is D. And you just look it up, and you can see the ex-dividend date, when the dividend is going to be paid out, the yield, the payout ratio. So it's a good way to do research on a company's dividends, what their rate is, what their yield is, and things like that. So Fidelity makes it pretty good, pretty easy to look this stuff up. Also on Fidelity's website, you can set up your account to automatically reinvest back into the security. So in the accounts and trade tab, you can go in under account features and then dividend and capital gains. You can set it up to automatically reinvest in the security, or you can just take the cash into your core account. I reinvest all my dividends back into the underlying stock. Now, many dividends are so-called qualified dividends. When they're qualified dividends, are taxed at a lower rate. So it's all based on a table. You can see the table on the right side. It's based on your income tax rate. So the rightmost column there is what's the tax rate on qualified dividends. Well, if your income tax rate is 0, you're not going to pay anything on dividends. If your tax rate is 10%, your tax rate on the dividends is 0%. If 15%, you're still paying 0 on qualified dividends. So not until you get up into the higher tax brackets around 25, that now you start to pay or taxes on dividends, and you can see 15% for most of them until you get the very highest tax bracket. Well, you'll pay 20% on the dividends. So it's a pretty good deal. What a lot of retirees receive dividends, and they can get $50,000 in dividends and not pay any taxes on them. So that's a good deal. So there's some exceptions to that. So on REITs, a dividend on a REIT or a master limited partnership, the dividends on REITs or MLPs are not qualified and are taxed as ordinary income. So there's some caveats to the taxation. So there are a couple other conditions you should be aware of for a dividend to be qualified. One is the company has to be listed on U.S. stock exchange, and you got to own the stock at least 60 days before the ex-dividend date, and at least 60 days after. On tax-deferred accounts like IRAs, then any taxes that are paid is really paid when the money is withdrawn. So any earnings or gains that you make are really paid when the money is taken out. Now, for most companies, the yield is 3% or less for most companies, especially companies that are growing. So that's pretty common for them to be 1%, 2%, or even 3%. There's some companies that pay a much higher rate, 10%, 5%, 6% is fairly common for some stocks, like oil companies. Some companies also pay monthly dividends, so you'll get a dividend every month. Some companies, if they have a little extra earnings, they'll pay something called a special dividend. So that they'll pay that usually near the end of the fiscal year. They'll say, oh yeah, we made more than we expected. I'm going to pay you a special dividend. So it's an additional dividend. So most dividends are paid quarterly. So a special dividend is paid as an additional thing. You'll still get the quarterly dividends, but then you'll get an extra amount. So like we said earlier, REITs and MLPs, you'll pay a higher tax rate on the dividend. They also pay higher dividend rates, but you'll also pay higher taxes. And the dividend's not qualified, so they'll get taxed as ordinary income. But if you hold REITs and MLPs in a tax-deferred account like an IRA or 401k, then it follows the rules of those accounts. The more a company pays in dividends, the less cash it has to invest and grow. So a lot of people pay attention to this ratio called the payout ratio, which says how much of the profits are paid out in dividends. They kind of watch if it's 50% or higher, then people are worried that the company may not grow, they may not be able to pay their debt, or they may even cut the dividends. So people watch the payout ratio quite closely. For REITs and MLPs, their payout ratio is required to be at least 90%. Now, when it comes to dividend-paying companies, they have created these categories of companies. So one category is called the Dividend Kings. These are companies that have paid an increasing dividend payout for 50 years or more. So by increasing dividend, like maybe every year they may increase it by a penny, or they may increase it by 10 cents or a certain percentage, but every year it's been increasing. So these companies have been doing that for the last 50 or more years. They're so-called Dividend Kings. There's about 25 stocks in there. Another category is Dividend Aristocrats. The span of years is less, so it's 25 or more years of increasing dividends every year. And you can follow the links to find a list of these companies. There are also indexes and that you can buy ETFs on that follow some of these kind of dividend aristocrats. One ETF is called Noble, N-O-B-L. Now, notice they only pay a 2.37% yield. The companies that are in there, they are increasing their dividends each year. So if you bought Noble, you should expect the dividend to go up every year. There are other ETFs that are similar, DGRO, KNG and stuff like that. Now, if you want to look at even higher paying dividends, you can follow some of the links below. Now, if you want to look up other YouTube videos or blogs, here's some links. Plain Bagel is a good YouTube channel that talks about dividends and other financial stuff. One of the biggest dividend proponents on YouTube goes by the name of PPC Ian. So if you look him up on YouTube, you'll see he talks about dividends all the time and his dividend portfolio. And then there's various blogs on dividends. So I'll include these links in the description below. So I just want to give you a little history. I've been investing in dividend companies the last 3 years. So in 2018, I kind of surprised that I actually earned dividends, and I totaled it up and it was about $4,800. So in 2019, I made a real effort to buy dividend companies, and then so in 2019 I basically earned over $15,000 in dividends across all of my accounts. And then based on what I'm holding now in stocks, if I don't sell them, then I should earn at least $27,000 in 2020 in dividends. So ultimately, yeah, I wouldn't mind getting to having $50,000 a year in dividends. That'd be pretty cool. So some lessons learned from dividend investing. Make sure you buy before the ex-dividend date. The ex-dividend date is the date that you will not receive that current dividend. So you got to buy the day before, the business day before. And then if you buy REITs or MLPs, you want to buy it in an IRA or 401k type of account, because the dividends from those are taxed as ordinary income. So you want to be in a tax deferred account. So Canadian dividend stocks for the US investor, you want to hold those in tax deferred accounts also. Otherwise you'll end up paying a 15% tax on the dividend to Canada. And then other companies like Royal Dutch Shell, they have two classes, Class A and Class B. Class A pays a foreign tax, Class B does not. So if you're going to buy a Royal Dutch Shell, you want to buy the B class, not the A class. Now, I reinvest my dividends and then I buy more shares of the underlying stock. That way I'll get compounding over time. Also, there's another thing called unit trust, which is a kind of a special type of stock, and there aren't a lot of them, but they do pay high dividends and capital gains. And if you invest them, you want to read the prospectus on it very carefully, because some of those unit trusts have a limited lifespan, and you may buy into them at the wrong time, like when the lifespan's almost over. And then because the tax filing requirements require this form called a K1, you probably want to hold those in a tax deferred account. That way you don't have to deal with tax forms. Also, when you buy a dividend paying company, you may not receive your dividend for about 5 months after you buy the stock. And the reason for that is, say you buy on the ex-dividend date or shortly after, then you miss that dividend, and the board won't meet for another 3 months, because they usually meet every quarter. And so now you got to wait 3 months. They'll declare the dividend when they meet again, and most of the time it takes 2 to 3 months for them to pay the dividend from that next quarter. So you could be 5 months before you see any dividends. So this is a long-term thing. You can't get in and get out. The other thing is, if you are looking for higher yields like 10%, then you can find those, but when you buy those stocks, don't expect the stock price to go up. In fact, many times the stock price goes down. So you got to be aware of that, especially so-called BDCs, Business Development Corporations, which a lot of them pay 8 to 10% dividend yield, but their stock price hardly ever goes up. And then You still need some growth stocks within your portfolio. You don't want to have 100% dividend stock, because then you'll miss out on the big gains like tech stocks like Amazon and Google that don't pay dividends, but their stock price goes up a lot. So you'll miss out on those growth stocks if you just only buy dividend companies. Now, here's my current list of stocks that I hold by the end of 2019. It'll be hard for you to read this, but over in the rightmost columns, my expected dividend and actual dividends. So I broke it out by quarter, and then basically I listed what I received as a dividend every quarter. Now, if you just take that first line, if you held Apple an entire year with the number of shares that I had, 208, I would expect to get about $641 in dividends. But in 2019, what I received was the first quarter $149, second quarter $158, third quarter $159, and fourth quarter $160. And the reason the number kept going up because I reinvested the dividend to buy additional shares. So each quarter I'd get a little bit more dividend. And you'll see some other rows. You can kind of get an idea of when I bought the stock, because you'll see that, like the next line down, ABBV, which is AbbVie, I didn't get my first dividend until the second quarter. So I probably bought it, if I remember right, back in January of 2019, but I didn't receive the first dividend until the second quarter. And then I bought some more shares, and then by the third quarter, the dividend had doubled, mainly because I bought more shares. And then you'll notice the fourth quarter, it even tripled, so I bought even more shares. So you can tell from my record, my kind of buying pattern. Basically, you can see totals up $15,221 last year. And if I hold the shares that I have now, I should get over $27,000 in dividends. If you have any comments or questions about dividends, put them in the comments below and we'll see if we can answer it. And as always, take a look at my website, follow my Twitter account, my Instagram account, and Pinterest. I also have affiliate accounts with Personal Capital, Robinhood, Amazon, and my website's on Bluehost. So if you want to sign up, get a discount on there, you can use that link. And as always, click the subscribe button. If you like this video, click like and put your comments in below. We'll see ya.